Hello viewers, a very good morning. It is as usual back again from FX Kampala. In this particular YouTube video today, we're going to be looking at the major terminologies. Ideally, the terminologies that we're going to be looking at in these particular videos are those that are mistaken and not understood well. So the chance that we're going to have in this particular video is I will elaborate to you the definition of particular individual terminologies, the importance, the details about them such that ideally they will help us in one way or the other make money and increase on our ratings of profitability in the Forex business. If you haven't subscribed onto our YouTube channel, please do such that you enjoy the content that we do release. You can also visit other social media platforms of ours, that is Instagram, Facebook, TikTok, LinkedIn. Just type in FX Kampala. You'll find such amazing information. If you haven't clicked onto the bell below, click onto the bell such that you'll man those few people that we are notified, rather that are notified whenever we happen to release such content. Without any wasting of time, I'll get directly onto the reason as to why I created this particular video. We say there are quite a number of different terminologies. Terminologies to do with take profit, stop loss, buy side liquidity, sell side liquidity, order blocks, fair value gap, change of character. We have the break of structure. We literally margin leverage. We literally have a couple of different terminologies, which ideally isn't possible for me to mention all these in this particular video. So ideally, I'll look out for those particular ones that we can trade which you can't trade without knowing extensively or deeply. So I'll start with the take profit. I'll give you the definition of what a take profit is, and then its importance and the details associated with the take profit and why we should use the take profit. And by definition, take profit, or abbreviated rather TP, a preset level at which a trader closes a trade to lock in profit. So it's a preset level. We're looking at this level in price. You specify as you've done with your analysis. There is always that particular level that you specify that once the market reaches this particular point, then I'll have to take my profit. So it's a preset level. Before literally, after you've entered your order, that you specify that I'll be making such and such an amount. So it's basically a level where you specify and you say at this particular level, this is where you put your take profit. That when you happen to make profits, then ideally it's gonna help you close you automatically with a profit, rather than you automatically closing the trade when the market reaches that particular point. So it doesn't matter whether whether you're online, whether there is electricity, whether you're traveling, whether you're offline, whether you're watching the market or not. So the trade will automatically, because it's already a preset order to the broker, to alert the broker that the market has reached the point, the target where this particular individual wants to take their profits, and it automatically close the profit. So ideally, it's an automatic thing. Then the same happens with the stop loss. A stop loss is a preset level where a trader closes a trade to limit losses. So ideally, when I'm telling people, I tell them that a take profit is like take my profit. A stop loss is like stop me from making bigger losses. So we set a pre-level to specify that in case things go against us, there is always that one level that we shall specify the amount of money that we are risking on this particular trade, and also not losing a lot of our money. So the order that is going to help us do all this is what we consider as a stop loss. So with the stop loss, we ideally can increase on our profitability, can protect our stop loss. That is a measure of risk management, which is, carries a lot of a big percentage contribution in our trading when we are trading. Then the other order, the other terminology is a fair value gap. By definition, a fair value gap is a gap in a price action that occurs when there is a sudden movement in one direction, leaving behind an imbalance or a gap in the market. So ideally, when there is probably an increased number of buyers or sellers into the market, specifically more than the other, like say for instance, when the market is going up, we expect, of course, even though the market is going up, we expect at least to have a number of sellers, ideally, because the market is all about buying and selling, buyers and sellers fighting into the market. The one that wins the market, then they take their direction. So there is always that one sudden move whereby ideally there are literally like 10% of, sellers into the market, meaning that 90% or 90 point something 90 something are actually going to be buyers. This means that they are going to significantly push the market upwards. In the due process, there's always going to be that one gap that will always form. So that one gap that ideally forms causes imbalance into the market, which means that regardless of where the market is going, it has to always come back, fills this gap, and then continues in that direction. So ideally, if someone is trading, they can always come into the market, position themselves before the market coming back to fill that gap, and then they can always make money out of that. So the purpose of this, knowing this, it increases on your profitability. It increases on the knowledge that you have, you as an individual that is trading, that is going to make you more profitable than someone who is not well informed about these gaps. So if you haven't seen these gaps, you can check out within smaller time frames. Usually during the weekend we have that gap, but then I'm not looking at that gap. I'm looking at the gaps that usually happen on the daily. So that's what we can call as a fair value gap. Like I said, there are quite a number of definitions. There are quite a number of terminologies. There are quite a number of things to do with terminologies that are associated with trading that I can't ideally, do all this in this particular one video. Now, another terminology is what we call as the change of character. Change of character is we are mainly familiar with this when it comes to smart money concepts. Now, basically, a change of character, or sometimes some people call it chuck. It's a shift in market structure or trend, indicating potential reversal or the beginning of a new trend. So ideally, whenever there is a new beginning of a new trend, let's say previously you had an uptrend, there is always formed that line that we usually call as the change of character. So change of character indicates to us that there is a change of direction, and therefore we can always take advantage of that and position ourselves in the opposite trend and make money on this particular trend that is new at its beginning and become profitable at the end of the day. So knowing the change of character, it's ideally important. It's it's something that we should always look up to when we are trading. Then we have what we call as an order block. An order block is a specific price level or zone where significant buy or sell orders have been previously placed. So an order block is ideally that particular one point where we suddenly indicating areas of strong support and strong resistance levels. So these ones are crucial. These ones are important because they are areas that we're always going to look up to for us to make, significant decisions when we are trading and all that. Like I said earlier, these terminologies are quite a lot that I can't deliver all this in this particular video. However, I've put my contact at the beginning of this particular video. So don't hesitate to reach out onto us for assistance, for the mentorship, for literally anything to do, provided you have any hindrance, provided you have any barrier, just don't hesitate to contact us. We'll always be in position to help out. Have a lovely day. Enjoy.